So just like the word implies, liquidity simply means money. We're talking about liquidity in the forex market, or you hear traders talking about liquidity. They're basically talking about money. Now, there are areas and zones in the market where money resides. There is large pool of money on these areas in the market. Now, this money appears in the market in form of stop losses, buy or sell orders. Basically, when you buy a market, you're definitely going to put your stop loss. And when market hits your stop loss, money is leaving your account. Before the market makes any serious movement, to an upside or to a downside, often than not, it's going to take liquidity, which is money, before it makes that move. But money is basically what moves the market. The money is going, if the market is going up, it means there is enough money pushing it to that side. If it is going down, it means a lot of money is actually involved in the movement to the downside. There's a lot of money pushing it down. So when the market grabs the money, it needs to move to define direction. Definitely is going to continue moving there. All right. So when it comes to the market, before you see market make any serious move to a particular direction, there must be serious money involved for the market to move in that direction. So if you're talking about liquidity, it exists in two forms, either internal or external liquidity. Now, if you're talking about external liquidity, you're looking at liquidity that exists within an impulse leg. So up and creates the liquidity, right? It creates a defined price range. Just like we are looking at on this image here, you see the market has actually created a defined range. So if you're a trader, if you've been in our class, you understand that this is the new trading range, right? So this is the swing range. Basically, we are actually waiting for the market to either discount some of this impulse move before we continue the buy to the upside. So any liquidity that exists within an impulse leg, inside an impulse leg, you see that the market is range bound like this. That exists within an impulse leg is called an internal liquidity. Now, you see within this impulse leg, the market pulled down, right, and started consolidating. Right now, it has created an equal low. And of course, this is a POI, which is a demand zone. All right. Before the market gets to this demand zone, it started generating liquidity, equal highs. A lot of traders that trade retail strategy is going to see this as equal lows. That is double bottom. And of course, the break and retest, they're buying and put their stop losses just below here. So this you are seeing are stop losses. And stop losses in this market represent money. And what often does not happen is see that after traders have committed their fund on this zone, you're going to see the institutions do the reverse. They come here and give all the confirmation. They see they react off this zone, break this neckline, come back, retest it. Everybody have their stop losses here. They are going to come back to this POI and clear all these stop losses, use it to fuel their own order before continuing to the upside. All right. This is where internal liquidity exists. All right. Now, there are instances where you see within a zone or within an impulse leg, right? Within an impulse leg, you see the market creating what they call trend line liquidity within an impulse leg. So after the market took out this high, after the market created this trending range, which is this low and this high, right? It started giving you relatively, higher highs and higher lows. But you see that the range, the way the market pushed out from this zone is not the same way it's pushing out from this zone. So it's creating a trend line liquidity. The same thing here. Now, you know for where that this is the POI, which is the unmitigated demand zone, and this is equally the unmitigated supply zone in a bearish market environment. So often than not, a lot of retail traders that trade trend line strategy are going to be seeing this. This is the first touch, second touch, third touch. They are being paid, fourth touch, everybody. So a lot of people are buying. Upon the return of this place, more buy orders are going to be in this market. Now, mind you that there are people that executed order at this very zone, and they are targeting places like here. Price has not gotten there. What it simply means is that this their stop loss is still active in the market. Okay. Now, if that is the case, it simply means that if this market reverses from here, it's going to take all this money. So institutions are going to grab this money, use it and fuel their own buy order, and of course, you see the markets will go in the direction. That's why most of the time you see they just take me out and the market move in my direction. Exactly, the concept of liquidity is what has acted on you. Now, this is what often than not happens in reality. The same market grab all this liquidity, come back and fill that unmitigated demand zone and push to the upside straight. The same thing happened here. So all these zones is where you have retail stop losses. Retail stop losses exist in the market. Okay. And once those stop losses are taken, the market is going to reverse because this money is what is needed for this move to the downside to continue. Okay. So your job as a trader is actually to know where these things exist and pay attention to them. Now, if you're looking at this, you know that I was telling you last time that if you're looking at a swing structure, you see that this market break structure here, all right, created this demand zone. And of course, we saw a second break of structure we have with this order block, right? Now, most times, a lot of traders who are new to ICT or SMC smart money concepts are going to be considering this most recent break of structure. This is where a lot of SMC traders are going to be buying, all right? But when market comes here, the institutions need money to continue this market for it to continue going up. So what they are going to do in reverse is they are going to come here, right? Fill all orders. You're looking for candlestick confirmation. You're going to see those of us that are looking for double bottom, look at double bottom here, equally wait for pin bar. This is pin bar. Just after all execution, the markets will move a bit and come and wash all these stop losses and mitigate this demand zone, which is the zone below. And from there, you see the market rally like normal business to the upside till it gets to your tip, right? So this is what makes a lot of people say that the market is highly manipulated. So if you have a good understanding of liquidity and how it's being used and how the institutions would weaponize it against the retail world, you are going to do exploits in this market. Now, external liquidity exists in old highs and trend lines. So external liquidity equally have trend line external liquidity. If you have a scenario where you have this kind of price delivery on the charts, market is actually in a bullish environment, you see this stuff like this, all right? And now you see the liquidity that exists outside this zone, which is here. There's money here. And the liquidity that exists here are called external liquidity. Now, external liquidity within an impulse leg, which is a bullish market environment, is what is responsible for two things. If the low, that is, if external liquidity is taken at this low, right? If they take this one, you're expecting a serious expansion to the upside, serious expansion. Now, most times, if this one is taken, this one is what initiates a pullback or a correction. So in a bullish market environment, often than not, when they grab the external liquidity that exists in old highs, what you should be expecting is a correction of that impulse leg. You can see just after this liquidity was taken, this correction was initiated back. Now, after this one is taken, you're expecting a correction of this impulse leg. So if you are the type that actually like to trade corrections, right? So you'll be looking out for external liquidity to be taken in a bullish market environment. If the external high is taken, that is the liquidity that exists at the highs is taking, you're expecting correction. If the lows are taken, you're expecting bigger expansion. That is serious expansion. This is where you can actually catch a trade from this zone, right? And hold it for like weeks or even days. If you're looking at external liquidity, right? This is what I mean by external liquidity. Now, if you look at this setup, you see that there's only one sort of people that lost money on this setup, all right? Now, if you look at this setup, you see that this market had a support zone here. That is, this is a resistance zone, and this, of course, is a support zone. Now, if you're a retail trader, you're going to understand something here. You're going to see this setup here as a double top. This is a double top setup. Okay, so by implication, it simply means that the market gave reasons to sell. This is a resistance zone, support zone. Market printed a double top. And most often than not, when market breaks the neckline for a double top, we expect a retest of the neckline. This is where you want to sell from. What we were taught, right? And you're going to be entering your sell orders from here if you see a candlestick confirmation. And of course, we got a lot of candlestick confirmation here. This is a pin bar, indecision pin bar, and we now see, reaction, continuation candles, bearish candles in that direction. So basically, we're going to be entering here and we target the next support zone. Now, where is your stop loss going to be? If you are lenient enough, your stop loss is going to be above the formation like this. Okay. Now, the market reacted, put a lot of people into this trade, and you can see the institutions use one candle to take all the stop losses. And just after that, they pinned it. I can see the way the market collapsed. So if this stop loss, if you are taken out by this stop loss, there was no place you are giving room or you're giving chance to enter the move. You'd be like, I've even removed this stop loss. I wouldn't have put it. If the market is bearish, when the external liquidity is taken, right? Because if you see this price delivery here, it's obvious we are in a bearish market environment if you are considering structure, because the market actually broke structure here. So we have a low here, and then we have a lower low. This is a high and then a lower high. All right. So basically, the market is already showing structure. So when this external liquidity, which is the liquidity that exists at this swing point, is taken, is going to initiate an explosive move to the downside. It's going to give you an impulsive move to the downside because there's a lot of money here that when market grab this money, it's just going to collapse to the downside. The reverse is equally true for a bullish market environment. All right, guys, let's go to the charts and we see these things live in the markets. Now, if you're looking at these charts, right? So this is the chart of GU, 1 hour time frame. Now, if you look at this price delivery, you see that the market is actually bearish. And from this zone, you see that this was the high that took out this low. So it simply means that this is our structural high. This is our structural high. This is our low. So by implication, before all this happened, it means that our trading range is from this high here, to this low. All right. So basically, we are going to be considering POIs, a return to this other block. We have this, and we have this extreme order block, which is this. This is that extreme order block that breaks structure to the downside, right? So market reacted here. Definitely, we're going to take this one out. So as long as the market is still within this range and hasn't closed above here, we are going to be looking for reasons to sell. Now look at where external liquidity was taken here. All right. When price came back here, you see how it swept this high. Let me take out this so you can see it very well. There is money above here. The reason is there are people that were able to catch this place. They sold here, and they are all still expecting price to go down. So this move that happened, they were expecting it to happen here. But price started retracing. You can see immediately after price swept this high. You see the way it collapsed, like there is like the reverse inside the market. It collapsed like seriously to the downside. So before we start seeing the next retracement, the market took out this external liquidity. Okay, and that leads me to this very important point. Now, it's very important to know that if you are trading, once you discover you're able to establish the trend and you see external liquidity taking in favor of the trend, that market is not going to stop until the opposing liquidity is equally taken. That is to say that when external, the market moves from external to external. If external liquidity is taken here at the high, this money that is being grabbed here is going to be delivered at the next high, which is at the next low. That is the next external liquidity. Okay. Now, if you look at the zone where, let's look for internal liquidity here. So even within this setup, there is still internal liquidity that exists here. This is an internal liquidity, double high, double top. There's a double top here. Okay. So the market generated this double top for this extreme zone to work. They equally came around this place. So if you are paying attention to the chart and you already have this concept, you've understood it, it would have been easier to know that this is a high probability setup. Now, coming to the most recent zone where price, before we see this depletion to the downside, you see that the market actually generated liquidity on this zone, all right? After we break this low, you see what the market did. This is now our new trading range after this happened. The new trading range has become this. After the market took out this low, right? You know that this is our structural high, this is now our structural low. But the market now generated a trend line liquidity, right? This is a trend line liquidity on this zone. The trend line liquidity, there is a lot of money here. This money that is on this zone, a lot of people are waiting for this market to come and do the third touch for them to sell. It came back, took them out, and washed all this liquidity. So in this regard, the market didn't really grab the external liquidity, but took this internal liquidity, mitigate this other block, all right? And trade into this other block before we see it deplete to the downside. And this was actually what was responsible for this big move to the downside on GU, all right? And our new trading range right now is this zone. This has become the new trading range, this and this. And basically, this is now the new liquidity, right? This is the trend line liquidity here, internal liquidity zone. So you expect this market to correct. Two things are possible. Either they come around this external, they run this external liquidity, or they run this internal for depletion, continuation to the downside.
Hello, good afternoon, sir.
Good afternoon.
How can I clearly differentiate between an external liquidity and internal liquidity, and where should I be looking for, like in this setup you just did, for a selling opportunity?
So the very
Yeah.
first thing
Yes,
you
sir.
need to do is to know the structure of the market.
Okay.
All right. So this chart you're looking
Yeah.
at right now is bearish.
Yeah.
All right. So when you know it's
Yeah.
bearish, the next thing you need to do is establish your trading range. You need to know
Okay.
the range you are considering. In as much as the market is bearish, it's creating a swing zone. So if market is
Okay.
within a swing like this, you know that even if this correction starts from here, we're expected
Mm.
not to take close above this guy. Market can come
Okay.
up somewhere like this and generate this liquidity. When you
Yeah.
see stuff like this, you know that the market is actually setting up to trap a lot of people here for this zone to work, so that this
Oh,
supply zone can work. Now, there are
okay.
instances where you will now see stuff like this. They will do this thing
Mm.
back on this zone.
Yeah.
Coming back on this zone, the money they need to move down is still not enough. They're going to what? Run this one. This is external. When you
Yes.
see this one
Yes,
being
true.
taken out, right?
Yeah.
You have to open up your mind that this is even a better setup.
Oh, wow.
But
Okay.
it's even a better setup, and this one have got more juice, because you know that once this liquidity is taken, this market will not
Yeah.
stop to this low. So
No,
basically,
it will break it.
you can frame yourself from here. You frame this self from here and target this low.
Okay. Wow.
Yes. But the thing is,
Okay.
you have to be very careful when
Okay.
you are trading at external liquidity like this. You need to pay
Okay.
attention to candles. You don't want to see a heavy close above here.
Yeah, yeah, true.
What you want to see here is rejections,
Yes.
weak rejections, a lot on this zone. That's
Yeah,
what will
true.
give you confirmation that yes, this is just external liquidity being taken. All right.
Oh,
So
okay.
if the
Yeah,
market
yeah,
is
true.
bearish, right? If you want to be
Yeah.
framing trade using external liquidity, you want to be looking for the external liquidity to be taken at the highs of the swing points.
Okay. At the eyes,
Yes.
right?
Yes, in a bearish market
Okay.
environment. Now, if you want to use the external liquidity that exists at the lows in bearish market environment, it means you are interested in trading corrections. That is, you're not
Oh.
considering to take advantage of the impulse moves. Because when this external liquidity that exists at the lows are taken, often than not, they initiate the correction leg.
Yes, true.
Basically, so that's how you use it.
Oh, okay. Wow. Thank you very much, sir.
Yeah, you can see it very well here. After they took this one, the markets retraced back.
Yeah, yeah, true.
Yeah.
Okay. So you can actually trade the both ways, catching
Yeah. But
the
it's
first one and bet the correction.
very risky to trade the correction. Very risky to trade it.
Okay.
So I would advise, more especially if you cannot really experience that much, to always frame your setups in the direction of the major trend. Very risky because
Okay.
most times the market can just, give you a shift as if it wants to start correction and it continue going down. And most times if
Oh,
you're taking trading against the trend, if the trade just goes against you, you just have to take that SL, because if you continue to hold
yeah.
it and only bought valuing, the market can keep going down for.
Hello, good afternoon, Mr. Martins.
Good afternoon.
Please, I want to reconfirm. Does it mean that wicks on the chart represent liquidity?
No.
So how do we identify this liquidity on the chart?
So it's part of what we've done. How you identify it is you need to establish a trading range. You get anywhere there is a setup and there is stop loss there. You need to know where stop loss is there in the market. That's why I use this to explain it. If market is going down like this, you know that there are people that catch this sell from here. What did they use to catch it? The way they caught this sell was that the market breaks structure here, right? After breaking structure, you know that this is now their new swing trading range, this high, and of course, this low. So when this correction started, they waited for this correction, right, to start. So they highlighted their order block, which is their supply zone here. And they had their fair value gap aligning properly on this zone. So when the market got to this fair value, they took their sell. When they took this sell, right, they put their stop loss above like this. Where is the sell? When they entered here, they put their stop loss here. And the market started going down. Some of them we are targeting here, they are not greedy. Some are targeting another zone. Maybe there is a support zone below this place. They want to swing it. And they now put it like this. They are targeting this zone. Now market come here and started going back. Now, if you're in this trade and this market started correcting like this, right? The other thing to do is either you take your partial, you close your trade, or you break even. But now let's assume that these people have confidence in this market. They don't want to break even. They don't want to take partials. They believe the market must come here. So they left everything like this. Okay. Now, what these guys are going to do is they are going to draw this market, right? And they keep correcting back. By the time they get here, your trade is already at the entry point. So no profit, no loss. From this place, they now react and started going down. A lot of people is going to re-enter this trade again. The reason is they now see a double top. A lot of people from here, as at when the trade is here, they will re-enter this trade. And put their stop loss just above here again. And the institutions now drop the markets. I see them come back because they know that they've trapped all these people. Some that entered here, so we just put it above here. Like what I mean by that is, some are going to put it just above the confirmation candle here. Some that have a good account size, we put it above here. So above this high, there is a lot of stop losses. So what these institutions are going to do is they will bring it just a little bit above this high. And hit out all these stop losses. The reason is not that they really want everybody to lose money but then they want to sell. Now they bring it here, close all this trading loss, and they will now sell here. Market will drop. So how you know where liquidity exists is just imaginarily use your eye and know where people enter trade, and they are the place they should put their stop loss. That's why there's a trading saying that says, your stop loss is my entry. And if you start incorporating that in your trades, it may not really be in all moves, but when you are in a move, you are really in that move. So there are some people that these places where they are coming to take this stop loss is where they are going to sell. That's what we are saying here. Once this liquidity is taken, they are entering here. They will target this zone. And their stop loss will not be as wide as this guy's zone. You see how very tiny it is. These ones are wide, but this is tiny because you know that once the liquidity is taken and the markets give confirmation that it wants to continue, they will come back again on that high. That high is protected. So you can actually use a very tight SL and the market will go down straight. But most times, because of the fact that when liquidity is taken, right, we don't want to see a heady close. So that's why when institutions are coming to zones like this, they're going to use speed to come here, just like you saw on that slide. They will use speed, wipe this, and immediately reverse. That's why most times the liquidity or the move that take liquidity, you always see the reaction in form of wicks. So I won't say necessarily that you use wicks to know liquidity, but that wicks is that sharp move. Collect the money and go back. All right. And from there, they will start dropping it straight. So basically, that's why this happens a lot in the market is just because the institutions, the place they want to buy is equally where they want to buy. If the place they want to sell is where they want to sell, but they can't sell there because if they start selling here because of their large order of execution, before their orders gets executed or all their full orders get fully executed, price must have gone far, almost very close to the TP. Let me not confuse us.
Thank you.
Does it mean anytime we want to trade liquidity that we can also expect break of structure, like that's break of structure is is at stake? Is it because from what you analyze right here, I think there must be or there might be a possible break of structure for us to be able to trade liquidity efficiently.
Yeah, it's very important because why it's important is that is what's going to a reasonable extent. Just a second. Basically, why it is important to know direction is so that you know where the liquidity should be taken. Because basically, the reality is that somebody must lose money for the market to move. Yeah, that's just the honest truth. Somebody has to lose money for the market to move. Now, if you know where the direction is, you know that the opposite side of people has to lose money before we start going down. Why do I say so? The reason is this: if you look at this price delivery here, right, you see that this market moved from here, took out this low, so we are still bearish. Now there are people that know that this market is actually bearish, but they want to sell from here. This is where they want to sell from. They want to sell from this POI because that's the POI that breaks the structure to the downside. Early sellers. They're going to enter their sell just at the close of that candle. Enter the sell here. When the markets come back there, they're going to put their stop loss just above this place. Now, price came, triggered them. There's happiness, the market moved down. But they are targeting this old low as where the market should get to before we start seeing. Market didn't get there and come back. Liquidate all these early sellers. You see why we say that most times it's always like it's weak that you used to know liquidity. This was a liquidity run. A liquidity sweep above this guy brought the market back to mitigate this unmitigated supply zone. So they ran all these early sellers, took their stop losses, come back here. So these people, their buyers were correct. They know that the market is going down, but they sold early. Their POI was the one that was not correct. They sold early, used tighter stock, market run them, mitigate this zone, right? So once you see this rejection, know that mitigation, rejection, you load it straight. If you are not using pending orders, you're loading it straight. But even if you go to lower time frame, definitely this is going to be an engulfing on this zone. Go to 5 minutes. Yes, there is a bearish engulfing of this zone. Just with this, you are entering, loading it big time. So there's still much we're going to do on this. So, but just know the zones is one, entries and all that. Where you need to see the confirmations to start going inside.
So hello sir.
Yeah.
Sorry, I'm having a little bit of confusion here. Like based on what you've explained, right?
Yeah.
Are we to wait to the market? Like, okay, the market is bearish right now. So before we look out for another position for a bearish move, are we to wait for the market to get to the last unmitigated area?
Yeah. So this is the setup that is
Oh,
actually playing out right now. Yeah. If you see before
okay.
this market move, this is our new trading range, this high and this low.
Yeah,
You get.
yeah, yeah,
So when you highlight this high, this is the POI, which is extreme POI. You expect
yeah.
the market to come back here.
Okay.
This is where you want to
Okay.
sell. Already there is this
Oh,
trend line liquidity. But this trend
yeah,
line
yeah.
liquidity is not strong enough. If you see a move like this, then reaction is going to make more sense because this is now going to give us a double top liquidity. Market respect this
Okay.
more often than not. If you don't see this kind of setup, we see this like this, then it makes more sense why we expect this zone to go. So what's going to happen is market
Oh,
will run these guys and continue down.
okay. Okay.
The event that he did not see this, he now expects external liquidity to happen. Stuff like this.
Oh, okay. Wow, wow, wow. Okay. So, sir, am I to, sorry, this last question, am I to look out for this mitigation area on my recent trend? That I'm a day trader and I look at my recent trend on 1 hour or my entry time frame on 15 minutes?
So coming back here, right? If you're
Yeah.
not too confident, because most times where you have to go to lower time frame is if you're not too sure of the zone, then that's why you need confirmation. Confirmation means that you're not sure. All right. So
Oh,
going
yeah,
to
yeah.
lower time frame is you want to see that the market is actually respecting that zone before
Oh,
you now
okay.
start going in. Okay.
Oh, okay.
Yeah.
Well, thank you very much, sir. Thank you very much.
So guys, I appreciate you guys. Thanks for coming around. Keep grinding. Cheers.